So I'd like to share my presentation now on the fundamental outlook of the market. So let me just share my presentation. Okay. So anyway, I mean, like in the past, we seem to have a great narrative for Philippine stocks right now. And everything seems to be in place for a bull market to finally begin in the local stock market. So you can see the list here, and I'll talk about them one by one. I mean, first of all, inflation and interest rates have peaked, and that was the problem in 2023. As you can see, inflation after peaking in the first quarter of 2023 and rebounding slightly in the third quarter. It's been on a downtrend, and the latest figure we have is 3.9%. In December, which is finally within the BSP's desired range of 2 to 4%. The 10-year bond rate, in the Philippines, as you can see, it climbed all the way up to 7 point something percent, and it has gone down to 6.1% as of this writing, which is good news. After falling to the 2+% handle in 2020, 2021. One of the things causing interest rates to go up is, of course, the Fed rate hikes, or the Fed increasing interest rates because of inflation being a global problem. So if you look at the chart below, you can see that the BSP rates need to maintain a certain margin above the Fed rates for the peso to stay stable. I mean, once that spread shrinks, you will see the peso weakening significantly, okay? But if you look at the chart above, you will notice that the market right now is anticipating Fed rate cuts of up to 150 basis points in 2024. But if you look at the dot plots, it's 75 basis points. Now, the BSP has already said that, they think they'll be doing rate cuts to the tune also of 75 basis points. So I think, this is good news, because if inflation has peaked and, the Fed also starts cutting rates, then there is a better chance that our BSP will also be cutting rates. Okay, and I think what's good about lower inflation and lower interest rates is that it will spur consumer and investment spending. So here I would like to highlight how you can see, for example, consumer spending after hitting a high of 7% in the fourth quarter of 2022. It has gone down quite significantly in the second and third quarter of last year, and this is because of high inflation and people needing to, allocate their money into, buying less things because of the higher prices of goods and services. And another reason why, say, GDP growth in the second and third quarter, as you can see here, fell to 4.3%. And 5.9% was because of gross capital formation or investment spending. In the second quarter of 2023, it increased by only 0.3%, coming from a 12.6% increase in the first quarter. And in fact, it even contracted in the third quarter. And the reason for this is because of high interest rates. Businesses became a bit more gun-shy in terms of borrowing funds to pursue their capital expenditure plans. So if interest rates go down and companies can borrow at a cheaper rate, then they will most likely pursue these expansion plans that they initially put on hold because of the high interest rate. So it's very positive. Okay, and another positive thing going for the Philippines is the government's budget for 2024. You will notice, for example, in 2023, the government budget increased by only 0.3%. It's kind of minimal. Okay, but for 2024, the headline budget is actually up by 9.5%. If we take out finance expenses, of course, which will not go into anything meaningful, the increase is still 8.8%. So an 8.8% increase versus a flattish spending is a big difference, no? So that should also help spur economic growth this year. And aside from that, if we talk about why invest in the Philippines rather than in other countries, because we're more resilient to the global economic slowdown that everybody is talking about this 2024. You can see that this historically, household consumption accounts for around 73% of our total GDP. We're not dependent on exports, unlike other countries. No? So net exports is actually it's not even 9%. It's negative 9% because we are a net importing country. Okay. And on the other hand, remittances and our BPO revenues have been very resilient, notwithstanding global recessions. They have always stayed the same way. Okay. And because of that, because we are less dependent on exports, you can see how the Philippines' economic growth is going to be faster than that of a lot of countries in the ASEAN region. So for this year, the Philippines' GDP growth, according to consensus, is going to be at 5.7%, faster than Indonesia, Malaysia, Thailand, and Singapore. Only Vietnam is expected to grow faster than the Philippines in 2024. And I think finally, the the other good news is that Philippine stocks are very cheap. So as you can see, the PSEi index, we're trading at 11.5 times PE. So this is more than 2 standard deviations below the average PE of the PSEi index, which of course statistically means that there is a very high probability that over time it should trade at a higher valuation. And of course, foreign investors have sold virtually everything that they've bought since 2010, as you can see, the cumulative net foreign buying here. So those are just some indicators that say, it's just faster for them to come back in. And there is a lot of upside in terms of valuations of Philippine stocks. But, that said, notwithstanding the very positive story of the Philippines, there are a lot of risks to this positive outlook. First is that inflation and interest rates could stay elevated, at least in the first half. And while the government's budget is going to go up substantially, it is vulnerable to negative surprises. And then, of course, the US, in our opinion at least, faces a heightened risk of a hard landing and a bear market. So historically, like if the US suffers from a recession and a bear market, the Philippines has always suffered from a contagion. And finally, we could see an escalation of geopolitical tensions. Of course, we cannot do anything about that, and nobody knows what could happen. But, I guess the question is, if the US faces heightened risk of hard landing and a bear market, could this time be different? Can we escape contagion? Of course. So that's another reason why we should ask, could this time be different? Okay. Anyway, so as you can see here, if you look at the table of inflation and food inflation, you'll notice the reason why inflation shot up in the third quarter of 2023 was because of food prices going up substantially. And one of the reasons for that is because of the El Nino phenomenon. And unfortunately, El Nino will still be around in the first half of this year, and this could lead to, again, an increase in the prices of grains such as rice. So that said, there is upside risk to inflation in the first half. And because of this, the BSP has already said that, most likely they will not be cutting rates until the second half of 2024. Okay, so now let's talk about the budget. So this is the budget again, which I already shared a while ago. But this time around, I'd like to highlight the assumptions that the government made, which is why they were comfortable doing the 8.8% increase in total budget, excluding finance expense. They were assuming that they could do a 12.2% increase in revenues due to the passage of new taxes And for GDP growth to reach 6.5 to 7.5%, and for inflation to be 2 to 4%. But anyway, where could the negative surprises come from? Well, we could suffer from a weaker than expected GDP growth. Um, as I said, inflation could be higher than the 2 to 4%. Um, you know, um, and if interest rates stay high, maybe, GDP growth might not be as good. And, consensus estimate for GDP growth is 5.7%, but the government is expecting it to be 6.5 to 7.5. So if you have a weaker economic growth, then maybe the revenues will not be as much. Another reason why I think, the government might not be able to generate the revenues that they expect to generate, because none of the new revenue measures that they were counting on have been passed yet. And in fact, the new DOF Secretary Recto already said that they will not be passing any new revenue measures. Okay, but here you can see in the assumptions for the budget, the reason why they assume that they could spend 8.8% more or 9.5 more, including the finance expenses, because they would get 120 billion in additional revenues from new taxes. Okay, and from here you will notice that bulk of the new taxes will come from excise taxes on sweetened beverages and junk food, around 75 billion or 63% of that. But then up to this point, we still don't have any sponsors for that bill, and this might not be passed in the sense that it's not a very popular tax, and it could mean political suicide for whoever decides to pass this tax measure, because it's considered to be anti-poor. So just some concerns on the tax revenues. But on the more positive side, in 2023, we saw the government improving tax efficiency. So I think that is something that I would like to look at. If the government succeeds in becoming more efficient in tax collections, then maybe they can get away with not having to pass new revenue measures in the next few years, and being able to grow the revenues notwithstanding. Okay, but for me, the biggest risk that we face is the potential of the US suffering from a recession in a bear market. So I think this is something that I've been talking about during the past two market outlook sessions already, and this is the third. But things haven't changed, and in fact, they've gotten worse. As you can see, the US leading economic indicators is still way below zero. And the shaded part is recessions. And you can see in the past, every time you saw the leading economic indicators fall below zero, you saw a recession happening sometime in the future. And this time is no different. The leading economic indicators has fallen below zero, and it could take time, but eventually the recession can come. Okay, and if you also look at the money supply growth, I mean, historically, this chart is up to 1960. You've never seen it go below zero, but this time it fell below zero. And there is such a theory as the monetary quantity of money theory, where MV is equal to V times Q, P times Q, sorry, which measures inflation and GDP growth. So if your money supply is negative, it means that GDP growth is, not good. The outlook is not good. Anyway, and another thing is, okay, people now are very excited because the Fed has decided to pause. Okay, but I just want to highlight that in the past, when the Fed stops raising rates, it's always, or most of the time, more bearish rather than bullish, because the Fed almost always over tightens, and this leads to a recession. So if you look at the chart here, you will notice Fed raises rates, then what happens? There's a recession because they over tighten. So this almost always happens. Okay. So even here, in 2000, and then this is the global financial crisis, and this was before the pandemic. So this time you can see how aggressive the Fed raised rates. So and also aside from that, the yield curve inverted. So that's another reason why we're a little bit worried. So if the Fed pauses, that's not necessarily over yet. That we should always that we should be celebrating, because in the past they don't have a good track record of knowing when to stop raising rates to stage a soft landing. Anyway, and aside from that, stocks aren't cheap anyway. Stocks are not pricing in a recession. In fact, they're pricing in a soft landing in the US. So that is another reason why I'm a little bit worried about the US. So this is the US PE band, and you can see that the S&P 500 is trading at more than at one standard deviation above the mean, which means that people there are a little bit more bullish. Okay, and historically, as you can see, the Philippine market always suffered from a contagion. If the US market suffers from a bear market, the PSEi also goes down during the same period that the US suffers from a bear market. Okay, so in 1990, for example, the PSEi fell by 30%. In year 2000, during the dot-com bubble burst, the PSEi fell by 36%. During the global financial crisis, the PSEi fell by 44%. And then during the pandemic, we fell by 26%. Okay, so I don't know if this time is going to be different. I guess, where can I be wrong? Well, if you look at how the US market performed in the past, after the Fed paused, there were times in the past when the US market rallied first for 6 months and even 12 months after. So if we look at the past 7 times the Fed hiked interest rates and they paused, you can see that 4 out of the 7 times, the S&P actually increased 6 months later, 12 months later, and the average increase is actually quite substantial. So, as they say, while the music is playing, we should continue to dance, diba? I mean, we might be leaving some money on the table and it's sayang. So the question is, what about this time? Can we see the market sustaining the rally? The Fed paused raising rates July 2023. Okay. Today will be the January 26 will be the 6th month. So by today, most likely the market will be up. But the question is, can we sustain it in the next 6 months again? Okay. But if you look at the past rate hiking cycles, there are certain things that I've observed during the past 7 times. Even though the market managed to rally, the US economy eventually suffered from a recession and a bear market 6 out of the 7 times. Okay, the only time that there was no recession and no bear market was in 1995. Okay, but then the reason why this happened was because the Fed successfully staged a soft landing. And an indicator that the Fed was successful in staging a soft landing was because the yield curve never inverted. Okay. But here you can see all the other times the yield curve inverted, meaning the yield on the 2-year bond went above the 10-year bond. Okay. So that is an indicator that the Fed is already over tightening. And this time around, you see the yield curve being inverted since July of 2022. Okay. And the 4 times that the market rallied, because I said here that 4 out of, see, 1989, 1995, July 2018. Anyway, June 2026. So the 4 times the market did rally, the recession did not materialize in the next 12 months since the pause began. But this time around, a recession could happen anytime soon, and that is my concern. Okay, why is that? Well, if you look at the time of the start of the yield curve inversion to the number of months before a recession materializes, on average, it takes around 18 months. And the yield curve started to invert in July of 2022. So if you compute January 2024, it's already the 18th month. Okay, so on average, recession materializes 18 months after. And if a recession happens, there is a risk that a bear market will continue and a rally cannot happen. Okay. Anyway, so let's talk about PSEi index targets because a lot of people ask about that. So we usually have our bottom-up index target, and our bottom-up index target seems to be quite bullish because it's 8,200. But I think there will be no re-rating of the market. The weak sentiment will still prevail because there are no really very exciting stories out there that would cause investors to come in, at least not in the near term. So most likely, um, 7,100 will be a more realistic target for the PSEi index. Okay. So what is our recommended strategy? Well, at this point, we're still recommending a more cautious approach. We're still recommending an overweight in cash. And I'd like to explain why. Because, well, if you have cash, there's your opportunity to earn high yields. And aside from that, of course, when you have cash, we're not saying completely stay away from stocks, don't look at stocks. I think it's an opportunity. You should look at it as having dry powder so that in case the market gets sold off, you are able to capitalize on any potential sell-off to buy stocks at a very cheap price. We're still bullish on bonds because it's your opportunity to lock in on high yields. And in case interest rates do go down because of Fed cuts or, weak economic outlook or the peaking of inflation, then you could potentially book trading gains. But then again, of course, focus on investment grade because quality is very important. And on equities, we're not that bullish, but we believe that you have to still have stocks, okay, especially in current conditions where valuations are very cheap. But of course, we don't know if the bull market will happen this year or next year. So that said, we're adopting a more defensive approach. We're recommending more of dividend-paying stocks and REITs because we believe they will benefit from the peaking of interest rates. And then, of course, we're choosing more defensive stocks belonging to, say, the power sector, utilities, telcos, and then for consumers, those that are focused on essentials, and properties, those that are heavier on malls. Okay, so these are a list of my stock picks. I think they are very much the same as before. I'd just like to highlight the changes. For example, for the consumer stocks, we switched out of Pure Gold into Monde. So for us, Monde is a more defensive consumer stock. And we also like the turnaround play for Monde. So we think it is a better stock to own rather than Pure Gold. So we're recommending a switch. And we've added PLDT because we think that the worst is over for telcos and the valuation is very cheap. And it's also in line with our strategy to focus on income. As you can see, PLDT provides a dividend yield of 7%. And you have a capital appreciation of around 34%. Now, in case you say, well, you're recommending so many stocks. If I only had, the room to buy 5 stocks, which 5 stocks would I buy? I've put a star on the stocks that I really like right now. I like A-REIT, C-REIT, Aboitiz Power, SM, and Monde. So if you were to buy 5 stocks, I would recommend those 5. Now, if you want to buy stocks, according to the different themes that you believe will happen, say, if you believe that interest rates will go down, I would recommend buying more of the REITs and property companies because they would benefit from falling interest rates. High dividend yield stocks like AP, Meralco, and PLDT. If you just want income, we have the high dividend stocks like A-REIT, C-REIT, Aboitiz Power, Meralco, and PLDT. If you want defensive, we have the REITs, power, telco, and even consumer. And then a play on consumers, which are more resilient. You have SM and Monde. Then you have large cap value, very cheap stocks. Ayala Corp, GT Capital, Metrobank, and PLDT. And those with attractive bottom-up stories, A-REIT and GT Cap. Okay. So what are the risks to my call? Well, I am assuming that the US market will, or the US economy will suffer from a recession and the US market will suffer from a bear market. But US stocks could continue to rally if a recession is delayed. That is assuming that the US government continues to spend and therefore lead to a delay in the bear market and a recession. Then potentially we will see more of what we're seeing right now is low interest phase, high volatility in Philippine markets. And another potential risk or or possibility of why a bull market could materialize if the US market goes down is if emerging markets decouple from US equities. Okay, so in summary, Philippine stocks could finally enter a bull market this year as the outlook for economic growth looks bright and local stocks are cheap and underowned. But the major risk facing local stocks is contagion, coming from the possibility that the US could suffer from a hard landing and a bear market. Because when recessions and bear markets happened in the past, the Philippines always suffered from a contagion. And because of this risk, we're recommending investors to focus on more defensive stocks, which are more resilient to economic downturns, and those that provide income through cash dividends. And it would be wise for investors to keep some cash so that they can capitalize on opportunities to buy stocks at even cheaper prices, assuming that they are sold down because of contagion. So that ends my presentation. Serge, I'll turn over the floor to you.
All right. Yeah, thank you so much, April. So we're a bit cautious this round. So I think at least on the top of your presentation there, you mentioned certainly there are arguments for the bullish case for markets, but it looks like that some very real risks remain, especially from a historical standpoint. Before we go though to our next speaker, I just have one question. So your view really leans more towards the cautious side for equities, given the aforementioned risks. But if in case, like let's say these risks do not pan out, what would be the reason for the market to actually have a sustainable rally? So like if we take naman the bullish side of the argument, I guess the question is, what will prop up the market in 2024?
Well, that's a very good question. I don't know. Maybe if China actually turns around, and I mean, okay, think about it. If the Fed actually successfully stages a soft landing and interest rates go down, then the dollar weakens, the peso strengthens. Then of course that's good for the market, no? Maybe we will finally see foreign fund flows return to the Philippines if the peso starts to strengthen even more and the dollar weakens.
Yeah. All right. Yeah, great. Thanks for that, April. So I guess for our listeners, that's something that you might also want to be taking a look at. I guess the China side, if things brighten, on that side of the world, of course, Philippines is an emerging market. China is an emerging market. It's the largest one. If sentiment there maybe turns, perhaps, and we don't see all of these risks pan out in the US, perhaps the Philippines could see a good year. Okay, yeah, thanks for that, April. So for those of you who would actually like to get more frequent updates from April, including her stock picks. Please follow her Calling the Shots report, which she releases monthly, by going to our research tab once you log into your COL accounts. And for a copy of this presentation, which she presented, it will also be uploaded there. So please be on the lookout this next coming days.